Welcome back to India Business Report. The year went out to muted celebrations of the final agreement of the Uruguay round of the GATT. 7 years of hard bargaining ended rather messily, with last-minute brinkmanship between several Western powers, in particular the USA and Europe. Those poorer nations, described as from the South, could be forgiven for feeling cynical towards the whole affair. Although 117 nations signed up to the GATT, many Western nations have been busily forming regional trade blocs to support own recession-hit economies. The South has been mostly left out in the cold.
The attraction of New Delhi's winter sunshine wasn't enough to persuade those members of the G15 southern nations to attend their economic summit meeting. 12 cried off, leaving this particular attempt at economic cooperation aborted. But one head of state who did turn up was Zimbabwe's Robert Mugabe, perhaps because his country, like the host country India, feels left out of any major world trading bloc like the American, Canadian, Mexican NAFTA, the American, Chinese, South Asian APEC, or the European Union.
Until we in the South, we in the third world, we in the developing world are strong enough, as strong in terms of our economies as we are strong in terms of our population, we will, in spite of the size of our population, always remain the underdogs in the world.
Prime Minister Mahathir Mohamad, envied by third world leaders for transforming Malaysia into an economically powerful country, realized much earlier that trading interests would replace ideological conflict between countries in the 90s. But he seems to have been overtaken by the same vision with which he co-founded the Association of Southeast Asian Nations, ASEAN, a large regional trading bloc allowing preferred access to neighboring markets. Mohamad is now having to fight giant economies like America and China, who have joined hands with ASEAN to set up the Asia-Pacific Economic Cooperation, APEC.
They object to our proposal that we should have an informal grouping called the EAEC, East Asia Economic Caucus, which is again an informal grouping. So on the one hand, they oppose EAEC. On the other hand, they are trying to boost up APEC and to use APEC in order to balance the influence of the European community. Now, APEC was not initially intended to balance anybody. It was just for our mutual benefit.
This turmoil in the trade flows of developing countries could end up cementing new alliances between countries hurt by the collapse of South-South cooperation. Countries like India and Iran, or India and Sri Lanka, with a competitive advantage in commodity trading, could now forge new partnerships. Clearly, pushed against the wall, South countries are beginning to shake off earlier sluggishness and learn lessons from counterparts who not very long ago were their comrades in distress.
The G15 is not just Mexico, it's not just Argentina, it's the whole world of the southern countries with a much larger population than the north. If you take us together, the Asia, China is not in the north, China is in the south, and it's a sympathizer and of course a country that we would rely upon to support policies in the south. The issue is that of imbalance between our economic relations, the north and the south. And if we strengthen ourselves in the south, that in the long run will tell.
President Mugabe of Zimbabwe. What has India to gain or lose from the Uruguay round of the GATT? Opinion is divided. Those More business and market news later. Hazel O'Leary is the first member of President Bill Clinton's cabinet to visit India. The importance of her visit was clear on two counts. It was the largest business delegation sponsored by the American president out of the country. They even flew in on the president's own jet. The visit took place at a time the country's principal opposition party is opposing the showpiece Enron power project for being given too many concessions. Hazel O'Leary had to summon her charm, wit and bargaining skills to negotiate 11 joint venture projects on behalf of America's power industry, which sees India as its second largest market. Sunita Kaul reports.
What has won us, madam, completely, in cricket terms, we say what has bowled us or stumped us, is your very transparent and genuine concern for us, the energy sector in India.
It wasn't clear who was wooing whom. The Indian Power Minister seemed eager to please the visiting Americans. He said an increase in power tariff was inevitable, as was private investment. But the American minister broke formal barriers, deciding to get close to her audience for the audiovisual hard sell. While she spoke of energy in a philosophical sense, there was little mention of the problems surrounding over 35 foreign power proposals, two-thirds American. Despite 3 years of economic liberalization, these foreign power projects have not moved beyond the Memorandum of Understanding stage. Getting them going seemed to be the visiting minister's priority number one.
There are, in fact, 7 projects ready to move out of the queue and go to financial closing, which is the most significant thing. After that, we'll look for groundbreaking. I am fully confident that in the next 2 to 4 weeks, these projects will move. I would not be surprised if several of them move through the process before I leave India.
Foreign power producers have been asking for an assurance that India's state-owned distribution companies would pay them for energy supplied. But the reality is that bankrupt state electricity boards, SEBs, are unable to meet existing payment liabilities of nearly $2 billion. So foreign companies are asking the central government to counter-guarantee provincial government payments in case SEBs fail to pay. This has been conceded in the case of the Enron power project, although the government is facing opposition in extending this as a general policy. On their part, the foreign companies also want long-term guarantees on supply of coal with penalties to compensate for lost generation in case of default.
It's not the companies that require the counter-guarantees. It's the financiers, the banks that have to lend hundreds of millions of dollars to finance these projects. And secondly, the guarantee over the long term does not permit someone to go in and take advantage of the government of India. If it's a good project, even if someone falls off, someone will come back.
But is there no alternative to counter guarantees?
No, there is not. Now, over time, the state energy boards will develop their own balance sheet, and they will have assets. And the state energy boards will be in a position to make their guarantees.
But this craze for guarantees is going on. For instance, now the US companies in power want the government of India to give them guarantees against coal supply.
Well, let's think about this now. Someone comes in and agrees to build a power plant, and you can't provide energy without coal. So I'm the banker. I'm the banker sitting in New York City or in Paris or in London. And I want to be certain that every piece of this deal is going to come through. And if you need coal to produce power, if I'm the banker and say, well, what guarantee do you have that the coal will be delivered? Or if it's not delivered, sounding like Mr. Banker, what guarantee do I have that you can get coal from someplace else?
You know what a sovereign guarantee of a great country like India is? It's more than gold. You are really pledging the debt onto the 900 million people. Is that advisable for sake of $2 billion?
The issue has acquired nationalistic overtones since domestic power projects have not been given comparable counter-guarantees. This has clouded some of the more reasonable demands of the foreign investors. Foreign power companies want a single-point clearance as opposed to 42 required now. Some of the companies are also asking for an increase in the guaranteed 16% return on equity to over 25%.
In the end, the free market will set the internal rate of return. 16.5% may be good today. Some other price may be good tomorrow, depending upon what happens in international markets. I think that, once again, the government and the people of India will figure this out as they go along and as they become more and more comfortable with dealing in this international climate, where, quite frankly, you don't borrow money without paying for it, and normally you get to pay for it at the prevailing rate.
Hazel O'Leary on her visit to India last week. Still to come, the Indian government's This week in India Business Report, is the record share price rise spectacular or speculative? Buying a car on credit, once shunned by Indians, it's now fashionable. Can a survivor of the Gulf War provide power to the Indian people? And a big name from the United States comes calling for $1 billion. Hello and welcome. This week share prices jumped to unheard of levels. The activity in the stock markets was uncomfortably reminiscent of April 1992, the month of the infamous Indian securities scam. Even at that time, speculators were talking about share prices being driven by strong fundamentals. The same language is being heard today. But this time the markets have a watchdog whose job is to make sure that nothing wrong is happening. Sunitha Kaul spoke to the usually low-profile Senior Executive Director of the Securities and Exchange Board of India, C.B. Bhave, and began by asking him if he was worried by the price rise.
Certainly as regulators we shouldn't be either justifying the price levels or decrying them as not justified. But we should again, to re-emphasize, what we should be looking at is whether there are any market abuses. And we have ordered an inspection of the Bombay Stock Exchange to see if there is any market abuse in evidence.
What are the checkpoints that small investors do not burn their fingers once again?
Yes, SEBI's role in investor protection can never extend to protecting the investor from the changes in prices in the market. That's a risk which is in the nature of this market, and any investor who enters this market must learn to live with that risk. If there is market abuse on the part of the intermediary, or the intermediary not giving the investor a fair deal in giving him the proper price or charging him the proper brokerage, that is where SEBI can step in. But if the investor loses on account of the market prices going up or down, that's not where SEBI can protect him.
Distortions still exist, like the book closure distortion.
I think it's been a little overplayed. When we looked into the book closure phenomena of the A group securities, we didn't find that the volumes in those particular securities were particularly high to give an indication that particular market abuse was going on account of book closures. But we are still investigating this with regard to the B scripts also. The uniform accounting year has also caused this entire phenomena to be bunched in a few months. But that is something that the market will have to live with.
Commitments are far exceeding shares during the no delivery period.
Now, if that happens, that will immediately be known the moment the delivery of these shares is demanded. And if the seller is unable to deliver, then the buyer has every right to ask for auction. And that is something that the stock exchanges as self-regulatory bodies must enforce.
Securities and Exchange Board CB Bhave. More business and market news later. Not very long ago, Indians were among the within Indian business. Before we end, a look at the new capital issues opening for subscription this week.
Bhagwati Gas hopes to raise close to $3 million with an issue of shares at a 50% premium. The company enters the market on Wednesday. The company plans to set up a second plant to supply industrial gases to the public sector Hindustan Copper Limited, HCL. Its connection with HCL provided both with its main strength and weakness. While it is assured of a buyer, its dependence on a single client could prove a handicap.
Although it appears from the prospectus that the company expects to sell about 60% of its production to Hindustan Copper, a realistic look at the demand from Hindustan Copper and the company's own capacity indicates that the company would be substantially more dependent on Hindustan Copper. If anything, they'd probably be even up to 90% or 100% dependent on Hindustan Copper for their sales. In this circumstance, it's inevitable that any problems with Hindustan Copper will affect the performance of the company. I think it is a fairly serious risk.
Even if HCL fails, by not taking into consideration that part of the production of 60%, by just selling the 40% in the merchant market, we will be able to service our equity as well as the debt, because our break-even is just 39%. Cash break-even is at 25%. So we don't envisage any problem.
Jackson Airlines hopes to raise $2.54 million with an issue at par that opens on Thursday. Although the group claims to have been the country's first air taxi operator, the operation is floundering. Two other group firms, Jackson International and India Ports Warehouse, have shown declining sales in 1990. The prospectus is silent on the group's performance last year, an omission which the Securities and Exchange Board of India, SEBI, says is illegal. Jackson Airlines will lease aircraft from Jackson International.
Each aircraft cost about 30 crores of rupees. So purchasing by Jackson Airlines at the moment is not feasible.
This arrangement doesn't seem to be necessary in the first place, and one doesn't know why the promoters are resorting to this kind of arrangement. This arises needless suspicion of diversion of funds from one company to the other.
Kamath Hotels hopes to raise over $11.5 million through the issue of equity and debt. Its shares will be priced at a 5-fold premium, while its debentures will yield 14%. The promoters of Kamath Hotels run 20 other firms in the same line of business, so there could be a clash of interest. In fact, this project envisages the expansion of a hotel that has been leased out from another closely held group company for close to $20 million. This will leave Kamath Hotels with very little assets of its own.
There are in the world, if you look at Century Hotels, if you look at Daiichi Hotel, if you look at all the hotels in the world, they are all managing hotels. The hotel property is owned by others and you are managing for 60, 50 or 30 years, and that is how the general practice in the hotel industry.
It is a cause of concern for the investor, not because it is beneficial for the parent company, because that is a little difficult to assess from here, but the possibility of transactions taking place not on arm's length basis is fairly high when such things happen. It would have been far more suitable for the company to have acquired the property itself and paid for it and have it registered in its name.
The project also does not have any institutional backing. The company also seems to be raising money far too early, as the project will be complete only in March 1996. Kamath Hotel's projections of profitability also assume unusually high levels of occupancy and ignore the outflow of interest on debentures that will start early next year.
In this particular case, the investors in this company will not be getting the benefits of the appreciation because the land will not belong to this company and rather would remain with the sister concern, which is also owned by the same promoters.
The week's new capital issues. That's all in India Business Report this week. We'll be back next week with all the news and analysis. Thank you for being with us. This week on India Business Report, the government surprises everyone and abolishes many controls on banking and frees interest rates. Before we end, a look at the new capital issues opening for subscription later this week.
The state-owned Punjab Communications is going public. It hopes to raise $33 million through the issue of shares at a 24-fold premium. The issue opens on Monday.
Punjab Communications Limited.
This is the highest share premium any Indian company has ever charged. Punjab Communications has so far fared well, earning about 25% on sales. A large chunk of its production is bought by the government's Department of Telecommunication. However, with the opening up of the telecom sector, Punjab Communications may see the end of the preferential treatment it receives in government tenders. Privatization will also pit it against sophisticated foreign competition.
That company is a government control organization, and since the last 3 years, I see that they have not spent anything on the R&D efforts. Moreover, the PCL's technical collaborations with international partners all have expired. So there's nothing new coming in, and there is no value-added service which the company has any plans to enter into.
Sai Service Station hopes to raise $6.3 million with the sale of shares at a 9-fold premium. The issue opens on Tuesday. This is the first automobile service station in the country to go public. While Sai is a dealer for India's largest selling car Maruti, another group company deals in the country's fastest selling scooter Bajaj. Its fortunes are linked therefore to that of both Maruti and Bajaj, who will soon face competition from a number of international automobile companies. More worrying though is the existence of 3 other group firms, all in the automobile business.
The other companies which you are mentioning are got specific activities which are delinked from my flagship. We have Sai Leasing and Finance, which is doing financing activity for Bajaj vehicles. We have Sai Automobiles, which are dealership for Mahindra and Mahindra. And we have vehicles, a Sai Agency, which has got a dealership for Bajaj vehicles for Bombay.
Yes, definitely there is going to be a conflict of interest. Moreover, this is a brand name created only in Bombay and Pune. What is the other growth factor in the company? And at the same time, when you have more other companies, the brand name is losing its importance because you are doing the same business in 4 or 5 of your subsidiaries.
JK Pharma Chem plans to set up a greenfield penicillin G project with the proceeds of this $15 million issue of partly convertible debentures. The debentures will be converted to shares at a 2-fold premium, while the remainder will be bought back at a discount. The issue opens on Thursday. Penicillin produced by Indian drug companies is 40% more expensive than that produced abroad. If this sector is open to international competition, the penicillin project could be in jeopardy.
I don't think so, because the imports depend on 2 things, price and quality. As far as quality is concerned, we have in fact sent out our raw materials to European plants of our collaborators and got penicillin made, brought it back, compared with the best in the world in both potency and strength. In terms of costs, we are confident that once in first 3 years, the incidence of interest and depreciation, that is the capital element of the cost, goes down, our costs will be as competitive.
The company projects a demand-supply gap of nearly 1,000 million metric units in 1996. It plans to fill this gap almost entirely by its production. While this makes its position appear comfortable, the equation is tenuous. The company's main rival is Max GB, a joint venture between an Indian firm and Royal Just Brocades, the world's largest producer of penicillin. If the Indian Supreme Court allows Max GB to take the public sector Hindustan Antibiotics facility on lease, there could be a glut of penicillin in the market.
The demand-supply gap which they have taken, they have not taken into consideration the, I think this one, the Torrent Pharma's capacity expansion from 1,000 tons to 1,500 tons.
Dalal Street Communications hopes to raise close to $10 million with the issue of shares at a 14-fold premium. The issue opens on Tuesday. This is just one of many companies that the present owners have in a similar line of business. This is also one of many capital issues floated by group companies in the recent past at substantial premiums. This could lead to confusion. Last year, a group company, Dalal Street Finance, floated an issue to raise money for a building to house a printing press to print a magazine for this company, but subsequently it chose to lease out a building.
Temporarily, yes, because the availability of the premises was not, as you know, property is not something that you can buy from a shop. Now we are already acquiring the premises, the one that we had originally planned to.
Part of this issue will go towards setting up a printing press. The company is planning a similar complicated arrangement in which one group company buys the press, another hires it out, but uses it to print for the same company it has hired the equipment from. This gives rise to the suspicion of an artificial creation of revenues among group companies. Meanwhile, analysts also question the hefty premium the company is asking for.
See, we are pricing our stock at a PE of 11, And I was recently at a Hong Kong television conference where I asked one of the international fund managers, how do you evaluate media stock? And his reply to that was 50 to 60 times.
Now, ZTV at a rate of 290 discounts the 1994-95 earnings per share at around 26 times. So I feel Dalal Street Communication is quite steeply priced.
That's all in India Business Report this week. We'll be back next week with all the news and analysis. Thank you for being with us. Welcome back to India Business Report. This week, the Hindu festival of Dussehra cast its spell on the primary markets. Traditionally a period in which the eastern part of the country goes on a week-long holiday and the business community elsewhere closes its books of accounts, the new capital issues market was unusually quiet. Senthil Chengalvarayan with Amit Nigam and Sunita Kaul.
NRI Finance plans to mop up $2.7 million by selling its shares at double their face value. The issue opens on Monday. The track record of the present owners of NRI has been far from impressive. Though the company has been reporting profits over the past 4 years, its share price dipped 25% below par in 1993, leaving it open to charges of share manipulation. Another group company, Afix, has been wound up, leaving thousands of shareholders in the lurch.
Due to various things must not have fallen in place, and that's why that company was closed. But if you look at it, per se NRI Finance Limited, its growth for last 3 years, its reward to its shareholder. We made a right issue at rupees 10 at par value in 1992. Today, the shareholders can, if he sells in the market, he gets 52 rupees.
The question is a moral question. It's a question that haunts hundreds and thousands and millions of investors. Should companies who have closed down, not paid investors, be allowed to tap the market again under new names, frauding customers and investors?
Madam, can you give me one group of companies whose companies are not closed for 100 reasons? It's a natural business phenomenon.
Triveni Sheet Glass's $5.6 million issue is currently open.